Now we're going to look abroad, and we're going to talk about what is happening in the U.S., what's happening with our exports, but at the same time, where is global product? Now, last week, because the EIA was Thursday, we were able to pick up Singapore and European data, so that will drop off. But again, we'll pick that back up next week because obviously the data comes out tomorrow. So we'll see that that some of those impacts. But before we get into it, we just wanted to talk about for a second some of the clean products coming into from Asia to the U.S. And here you can see just what that jump looks like, especially in February. It comes now. The arbitrage had already opened before Texas, and now with the Texas impacts, that has taken refining throughput off, which again is going to impact what happens and what flows north into Pad 2, and then really what happens and what flows into also into Pad 5. So right now there should be an opportunity, and just to give you an idea of kind of what's happening, Asian producers are shipping more into Latin America, and at the same time we have SK or South Korea. SK Innovations, or South Korean company, is sending more capacity or more product into the U.S., specifically kerosene, distillate, and gasoline. So that's going to be kind of that mix. And then at the same time, we also have capacity coming from Singapore, and it's heading into Mexico, and it's heading into other parts of Pad 5. And Asian surplus capacity, especially being very, very long gasoline and jet fuel and even diesel at this point, that's going to, again, open up more of this movement. So we will get this flood of product coming into the U.S., and that will help pull down some of the excessive amount of storage that we've seen in Singapore and then Fujairah and some of these other places, especially as we have some of the problems that continue to just kind of filter through the system, which is a bigger problem, which we continue to see on the product side. Now, when we look at some of the fuel consumption, for anyone who's been following, and we will have a report on this next week, we're just looking at Brazil because Brazil prices have exploded, and now that has created an issue between Petrobras and the prime minister, and I should say the president, and what is going to happen. That has forced executives to be replaced because they want to reduce some of these prices, because obviously inflation is a problem. We've seen these issues as well in India, where gasoline prices have hit an all-time high, diesel is near all-time high. And it's going to be a limit at, again, what is going to limit demand, but pricing, how much of that is going to be an impact. And we'll talk about that in a minute, where we look at that there has been a drop in Indian gasoline and distillate demand for the first half of February. And it's really driven based on some of the slowdown that we talked about, with some increases in COVID cases in some provinces, declines in others, and just some of those prices and those inflation issues, which has limited the amount of purchasing. But when we look at, and the reason why we talk about Brazil and what's coming into from Asia and Europe into the U.S. is because it will hit our exports. Now, right at this point, just because the arbitrage is wide open going into Pad 5 and into Pad 2, there's really no reason for, or at least a less of an incentive for Pad 3 to go into the open market when they can just go into the U.S. markets. So we're here, you can see gasoline dropped by 59,000 barrels a day, distillate 270,000. Both of those fairly in line with what we were expecting. Propane, LPG had an increase of 276,000 barrels a day. Again, the exports will remain elevated year over year, but they're going to start to normalize a bit just based on pricing. We'll talk about that in a minute. The bigger one is the export market. So you can see that we had a big drop of 1.548 million barrels a day. And we went from exporting 3.8 to now exporting 2.3. Again, we're expecting an average of 2.6 to 2.8. And because of some of the issues that we're seeing in competition in Europe and the competition in Asia, which is being shown by the physical market, some of these exports are having trouble competing, and this will just limit the amount of exports that we're going to see. Now, there will be a makeup just because the guys lost power. Pilots couldn't get on boats. That limited the amount of flow. So that was a structural issue, which has now been resolved. but the cyclicality of what we keep talking about, where some of this Asian demand is starting to weaken, and we'll have charts on that towards the end of this segment, just kind of showing where we need to look at this balancing act, because we do have some of this demand in the U.S. increasing, but we do have demand in Asia decreasing, and then Europe remains fairly flat. So again, it's just going to be a matter of where are these barrels moving at any given time. So then when we look at those gasoline exports, you can see that they're now back down below the 5-year average. The 9-year average. Now, our view was that it was going to stay above this level, but now, because of the issues in the U.S., the arbitrage opening up, that will now reverse. Now we will be below that 9-year average, because it's going to make sense to refill our pipelines. We had one pipeline going from Port Arthur up into Chicago that was down due to power outages. That will get refilled. That will pull through more, especially with this arbitrage. Colonial will be very full just because there's an arbitrage going into Pad 1. Again, this is going to keep some of this capacity, again, minimizing exports and keeping a lot of this internal. Now, when we look at distillates, as we were saying, it was going to stay, well below the 9-year average. Obviously, it fell back to. Now, obviously, this is an overshoot to the downside, but we still think that it's going to stay well below the bottom of that cloud. And just, again, there's so much diesel floating around now. We have an export on a VLCC. And again, VLCCs can carry a clean product as long as they haven't carried dirty product yet. So there's still a lot of VLCCs floating around out there trying to find a home. Europe is importing the least amount that they have in months. And again, that's just going to put more into the open market. That's going to put more into Latin America. That's going to impact our demand. And we do have that distillate side. So less exports just means that it's going to be pushed onshore, which coming full circle to what we've been saying, that the demand drivers will stay strong in terms of the U.S. on the trucking rail side, weaken on the heating side, mitigating some of that, but with this less exports leading more in storage, this will again reduce the pace of drawdowns, which is what we've been talking about. Then when we look at what's happened with crude oil exports, again, we're going to remain above the 5-year. We're going to stay, it's just going to stay within this cloud, something closer to about 2.6 to 2.8. And when we look at propane, as we were saying, I should say LPG, we were going to get a spike. We're still going to stay above the top of the range, whether it's a new seasonally adjusted all-time high or within that cloud. It's going to be within that comfort zone. The problem that we're seeing, or the benefit that we're seeing, is the naphtha. So when you're looking at a chem facility, there's a certain option or a certain amount of capacity. If you have a naphtha cracker, you can take in some LPG. If you're a propane cracker, obviously you can take in a certain blend of both. As we see some of these time spreads go up because of the shortage in naphtha and condensate, this will actually help U.S. exports, because what do we have but a lot of liquids? So this will help pull some into the market, but at the same time, it'll also help pull some of that LPG into the market, because you can replace some of your naphtha with LPG, which again will provide some of that opportunity. There has been some heating demand decline in the Asian markets, which again, it's not gonna hurt demand coming from the U.S., because instead of that going into the heating side, it'll just go into the petchem side. So it'll still maintain a certain amount of that pull through. Now on the oil import side, so here for India, you can see that we're right at where we were for 2019. The 2018 and 2020 were above this point, so we're just right at the top of the range, which is a net positive if you think about some of that normalcy. We're still not quite to where we were, and some of the slowdowns that we're seeing in demand will weigh on not so much what's happened. It's gonna weigh more on their exports, and we'll talk about what does that mean as we look forward, because the sale of the 3 major transport fuels in India's biggest retailers declined from Feb 1 to the 15th compared to a year ago. So let's put that into context. Sale of diesel, that fell 8.6% year over year. However, sales increased 9.1% from a month earlier. So again, there's this offset where We're still down year over year, but it's getting better from December into from January into February, which is a net positive. So we just want to look at what is that trajectory and where are we seeing. But again, when we compare it to year over year, we're still seeing some of those issues. Now, gasoline sales, which had been the fastest to recover, that sorry, I'm just lost my place. They fell year on year for the first time since August. And that is just one of those little slowdowns and what percentage? So it fell 2.4% year over year, still up 4.2% month over month. So we're still getting that bounce from Jan into Feb, but February normally is a better month. So that's why we're looking at the year over year as well as the month over month, because February should be better than January, but it's still not as good as it was last year. So just some of that kind of balancing act that we have to look at, which will impact the amount of exports that they have. LPG remains strong. It's up 5.4% year over year, 3.2% month over month. So again, there's some different sides of things, but what is the overarching theme? Gasoline price at fuel stations operated by Indian Oil Corp were at a record of 87.6 rupees a liter on Wednesday, while diesel was priced at 77.73 rupees. Again, taxes accounted for 61.3% of pump prices for gasoline and 56.3% for diesel, according to Bloomberg calculations. This is going to be a problem because there is a growing deficit in India because they're trying to stimulate the economy on a fiscal level. This is key tax revenue that they will not, or I should say, can't really reduce. They can reduce some, and that will be factored into what this fiscal response is, but it's going to mitigate the amount that can really go, or the amount of cuts that can happen. This is now, how do you respond to this? Well, when we look at gasoline exports remain at the low of the cloud. This is going to stay at these levels because given the pricing backdrop, why would you export gasoline? Gasoline in the international market is oversupplied. You have a pricing benefit internally. You're going to try to push as much of this gasoline into the Indian market, which will help mitigate some of those prices and keep that gasoline from getting much worse in the broader market. Now, when we look at some of the different capacity going into diesel exports remain elevated, and it's because there's 2 or 3 refiners for the most part. Now the third one can go both internal or external, but there are 2 of them that are very specific to exporting distillate. Now they can export distillate, but given where the pricing is, they'll probably export it into other parts of the province, and just because the fees going from port to port will be worth it. And the distillate market, the middle distillate market in particular, remains pretty oversupplied, especially in Asia. So that will mitigate some of this capacity so we would expect to see a drop in exports as more of this is retained internally. Now, with all of this being said, some of the different problems that we're seeing in the market is CPC blends are at the lowest price in almost 10 months on the Platts window, with SOCAR sold 2 cargoes of Azure Light. And then when we look at what does that mean, so when we look at traded prices, it's the lowest since the end of April, and it's compared with $1.70 for previous deals on February 2nd. So we went to they traded at the beginning of February at down $1.70. Now they're down at $2.45. Again, you're just seeing this weakness that's coming into the physical market as they try to move some of these barrels in general. Now, when we go forward, what are some of the other issues that we're seeing in terms of some of the pricing? So when we turn to the North Sea remains a little bit more robust, and that's more of a paper trade, as we said in the first segment, that there was an elevated movement in ICE Brent. That has helped where you can start playing the game between paper and physical. But when we look at some of the issues going forward, the problems are in the Ural CPC side, and then they're also starting to grow in the West African component. But with all of that being said, we're still seeing a nice drop in European crude, with another step down going into the this week. Now, this will start to flatline here just because we do have some movements of Urals into the market. We saw them get a bit more active as we head into March. Now, they got more active, but they were more active at a lower price. But again, they had to find a price where they could start crossing more cargoes, and we're starting to see that in general. Now, before we go into the broader market, let's just touch on what's happening in Fujairah. So here you can see that we had a big spike in storage. So Fujairah reported a build of a total of 23.2 million barrels, which was a total amount of an increase of 2.33 million barrels, which is overall stocks increasing 11.2% week over week. This is really what we were saying was going to happen, just given some of the backdrops of limitations into Europe, problems coming into the US. And the biggest builds were realized in light distillate, gasoline, and heavy residual. So stocks for light disti, or gasoline. So the build was 894,000 barrels, which is an increase of 12.4%, sitting at about 8.1 million, which you can see here. And this is their highest level since June 22nd of last year, when they stood at 8.244. So again, we're getting back to these elevated levels, and that's really pointing to some of the structural issues that we talked about with the U.S., but also some of the mitigating factors of demand in Asia that is leaving some of this here, and it's trying to find a home. Europe is sending more into West Africa, which is limiting the amount they can send into West Africa, just because Europe is trying to maintain and average their storage levels. So then when we go into the middle distillate, they fell by 99,000 barrels to 4.1 million barrels, which is down 2.4%. The gas oil market was stable in general, but this is going to fall under some more stress as the VLCC goes from Europe to West Africa. And we're seeing, these limitations coming all the way from Asia, or pulling more stuff from Asia. And then when we go a step further and we start looking at, what happened in heavy resid, as stock of heavy residual rose by 1.5 million barrels, or up 16% on the week, to about 11 million barrels a day. Again, there's been an issue in terms of just shipping, as we were talking about in segment 2. So there's been a little bit of a slowdown in shipping, which has mitigated some of the demand that we've seen in general. That what we're expecting is gasoline middle distillate will stay fairly elevated, but resid will start to draw down, just because there's a certain amount of timing as well in some of this data. Now, when we look at the loading schedule, as we turn to February, Russia took up their loading schedule for February. Then when we look at what's happening in March, Russia has actually taken their February numbers higher. So they're going to be closer to about 3.5 million barrels a day, which is elevated from about this 3.4. Norway will remain elevated. Nigeria, Angola, we're seeing some slippage out of Feb into March, which is, again, why they're trying to push some of these spot cargoes, just because when we look at what's happened with Angola and Nigeria, they've seen a lot of slowdown into Asia, specifically China. And they've seen some buying come back into West Africa, into Europe, which has pulled some of that through. And we just have to look at, what does that acceleration look like in general? The Congo is still struggling to cross barrels. And when we think about what does that mean in general, we have to hear some quotes that we were going to pull from. So West African oil exports to Asia this month are poised to drop to their lowest level since October. This is where we keep pointing to. This is going to result in more floating storage, as they were coming to a lower level from October, especially as they try to digest more of these cargoes that they've purchased in general. So shipments to China are set to decline to their lowest level since August, while exports to India are also set to dip. Flows to China in February are estimated at 34 cargoes, the lowest since August, which is a drop from revised 1.22 million in January. So that was 41 cargoes. They're going from 41 to 34. There's also the amount of purchasing that happens. It was February, Lunar New Year. So when we look at January and we look at March, it'll be important, because January was a big drop. Well, I shouldn't say big, but it was a bigger drop year over year, up from December, because December was really slow. January was slower versus last year. So it's going to be important to see what is March doing. And so far, March has been fairly slow, just because they're the first to load, they're the first to announce, they're the first to take bids, and we've seen that be fairly slow in general. Now, Gunvor sold a March for dated Brent that was minus $1. Now, when you think about what they had sold this Nigerian blend for, it had been at a $5 premium. Now it's at a $1 discount, just to give you an idea that they're trying to find a level to unload some of these cargoes. Japanese company bought an Abu Dhabi medium sour for April loading at about a discount of 10 cents to 19 cents off of official selling prices. So we're starting to see a little bit of panic against the official selling price. Again, the OSP is a starting point, and they trade either above or below by within a certain range. So it's not crazy to see this. It's just, again, speaking a bit more to the physical market in general. But when we look at the CPC, as we had said before, is at a 10-month low. URALS is at a 10-month low in terms of what is trading and what that price is. Now the CPC, again, was at negative 250 versus a negative $1.70. And when we look at URALS in general, the URALS are trading at either a negative 270, negative 235, or negative $2, depending on where things are. And when we look at URALS in general, traded at lowest price since mid-April, compared with minus $2 in February 17th. They're now trading at negative 270. Again, just trying to show there is this disconnect between sentiment in the market, reopening, versus what the actual market is digesting at this point in time. When you think about what should you buy, I mean, people are like, well, I'm bullish the reopening. It's like, okay, well, buy July, because July looks great. Then July is cheaper than right now, and you'll start to see some of that benefit versus buying, let's say March, April, or May. Might as well jump into where you think there's going to be that peak demand, and you'll get a better price on it. Now, when we look at oil on the water, it's fairly flat. This is something that will start to reverse back up, just given the activity that we're seeing in the market. But when we look at oil in transit, as we were saying, we expected a spike off of that 5-year average, just because there's more in the market. Nigeria and West Africa were able to sell some spot. That crossed, and was realized in this report. But when we start looking at what is going to happen going forward, we expect to see an increase in floating storage in both West Africa and the Middle East in general, but we'll get to the Middle East in a second. Then when we look at floating storage, this had a nice drop down to the bottom of the cloud. This is coming more from that pull through from Asia. So as China came back, they've now pulled some of that from offshore to onshore storage, and they're looking to make room for the floating armada that is coming to their coast to try to mitigate and try to speed up some of this movement, because it's obviously cheaper to keep it onshore versus offshore. Now, while all of this is happening, here's Iraq. So you can see exports. Oil sales increased despite pledges for deeper cuts. It's surprising, I know. They're going to continue to cheat, as we've been saying, that we expect cheating to continue from Iraq. Nigeria has, Nigeria is experiencing some market, obviously, issues in terms of demand, where Iraq has seen some benefit. Now, they have officially canceled the deal with China, which is a net positive for them, because obviously crude prices have rallied. So why sell at such a discount? Which, again, is going to be a net benefit for them. And they're going to try to increase their production to make sure that we get some of this, they'll capture some of this price increase. Here you can see that the Brent spread, or the front month, has surged. It's now 30 cents above the next spread, which, even though everything we're talking about when we look at the physical market, clearly when we look at the paper market remains fairly very strong. And it's just that disconnect between what is paper and what is physical in general. Now, when we look at what's happening with some of the Singapore margins and some of the margins abroad, we've seen a little bit of a spike, which has been a positive, and it's really because of what happened in the U.S. Some of the pricing declines that they've gotten on the feedstock side has enabled some of these spikes. You can see that we're still within a fairly tight range, so it's not too much right now, but we are starting to get a little bit of life. So we want to see how does this continue into March specifically, because then this would enable some increases. But we've also seen some pivots from what is the feedstock, trying to capture that lowest price barrel. And when we look at what happened in Singapore, looking at hydrocracking, you can see that we're still at the bottom of the cloud. But again, being at the bottom of the cloud is better than where we were. The issue now is going to be how quickly can this move. Obviously, the movement from Singapore, from Asia into Pad 5 is going to enable some of this movement, which again will be supportive of margins. URALS, as they priced at a bigger discount, which again, speaking to why they've seen a bigger swap increase. Here you can see just what some of those margins have done with hydrocracking margins for URALS now back above $5. This will help pull through some of this activity, but we're also seeing them kind of manage what their exports look like, which is why increasing exports means that they can increase the activity for their product at the refining side. Now, when we look at Northwest in the Mediterranean, so when we look at what's happening in the Mediterranean, it's a little bit flatter just in terms of what we're seeing from the Urals perspective. Just because the Med has a lot of competition. Libya remains very elevated. This is where the U.S. is also trying to compete. So this is flatlining some of the benefits that Urals are getting in this market in particular. And again, is just going to be a headwind when we can see how quickly can some of this real demand. I apologize, my kids got me sick, so being a little difficult. So when we look at the Mediterranean, this is where we're seeing a little bit of a more competition for Urals and others in general. So that's why we want to look at, okay, well, where is Libya crude going? Where is Russian crude going? Where's U.S. and where is West African crude going? And this is where you're seeing that competition, which should help support some of these cracks, but it'll push Urals to the side, which will hurt some of their exports, or at least increase the competition for their exports. Again, speaking to what's happening in the physical market versus what's happening in the paper market. Crude tankers for China, here you can see we're still well over the 5-year average. We're still well above seasonal norms. This is going to continue as we do have more movement heading into the Chinese markets. Now, Asian floating storage continues to fall, again, moving from offshore to onshore. This will reverse. It's just going to be a matter of when does this show up to be recorded as floating storage. As we were saying, North Sea was going to hold that 5-year line, and here it is. We're going to start to see this increase a bit just because we've seen some of the Asian buying dry up a bit, which will keep this fairly flat and start to increase it over the next few weeks. West Africa is the one where we got the biggest drop. We were expecting it to hold this 5-year average, but we did get several cargoes that went across at a fairly that big discount. Remember when we said earlier it crossed at $1 discount versus the $5 premium that we've seen. And this is just to move those cargoes and make room for that new program. So this is something that we're going to see this reverse back up and back into the 5-year average. The Middle East here is continuing to creep higher, and this is coming from Saudi Arabia's increased exports by 500,000 barrels. Iraq continues to be at the top end of the range, well above what they said that they were going to be at. And this is going to keep some of this crude stuck in storage as well as moving in. Obviously, we're still well below where we were in 17 and 16, but again, we're still at the top of this lower range, and it's going to be one to watch to see what that competition is, because if we start to see this push back a bit, this is going to be a topic of conversation as we head into next month in the OPEC meeting. Europe, as we were saying, it's going to stay around the bottom of this cloud, especially given the drop in the ARA onshore. And this is going to keep some of that going from offshore to onshore, which will be supportive of pricing in general. And again, we're also starting to see some reactivations of refiners, which is pulling through some of this crude. Now, when we said that the Chinese shift of offshore to onshore, here's where we're looking at the independent Shandong refiners, the teapots. They're back to a 2021 high and pushing the all-time high for the amount of crude in storage. And this is where we're starting to talk about how much demand is there. Demand is continuing to be a little bit light. And even though they're still operating at about 72% utilization rates, we're seeing some builds on the product side, which is going to mitigate just how much activity can we see in general. And then when we look at fuel oil stocks, they're moving in the wrong direction. And this is just because the export market remains soft. The internal market remains soft as well. So this is going to put more in storage, or they're going to have to start cutting their utilization rates. It will most likely be a mixture of all three. They'll try to decrease some pricing internally. They're going to reduce some of the exports that they have, and they're just going to try to manage some of this in general. And by decreasing imports, that's just because they're going to take their utilization rates down. We're seeing, depending on where you are on the state-owned side, some utilization rates are up, some are down against seasonal norms. On average, they're down about 5% of utilization rates versus where they should be. This is just going to be that marriage of what does activity look like, because Asia in general, mostly driven by China and India, have slowed a bit. So we want to see how does that play out in the market, because that's speaking to some of that physical pricing that obviously hasn't worked its way into the paper market at all. So these are things to look at. I know we covered a lot. If you have any questions, please let us know. We love the back and forth in the comments section. So then we have the Econ show coming out tomorrow. We'll cover a lot more, especially on the Chinese side, because we're going to go through some of these Biden policies that are starting to come out about how they're going to address China in general on multiple fronts, but more specifically what we'll look at is trade and technology. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.